So I think that we can start, and everybody who wants to join us will join us eventually. So hi everyone, thanks for joining us for our second workshop in the series of online events for brave Ukrainian founders. On our last event, we talked about fundraising with Semyon from One Way Ventures and with Michael from Innova Venture Partners. And today we decided to dive a little bit deeper into the business affairs and into the balance, into the question of balance between efficiency in growth in startups in tough times. Our guest today is one of my favorites from Twitter and Medium. This is Christoph Janz. He is a managing partner at Point9 Capital and an early or seed investor in such amazing startups as Typeform, Loom, Whereby, Zendesk, and other companies. So just to remind you the structure of our event today, we will have a short lecture by Christoph. After that, we will have a moderated Q&A session. And you may ask your additional questions if you have ones during the lecture, and we will try to answer as many of them as we can. So Christoph, thank you for joining us today, and probably let's start.
All right, well, thank you so much, Elena, for inviting me to this event, and thanks everybody for joining. It's really an honor to do this event at this time with founders from Ukraine. I mentioned to Elena before when we discussed setting up this event that I'm not sure should I really do a session about financing and tough times, because like what can I say about tough times, right? I'm in a safe place while so many of you are going through very existential threats and worries. So I can only talk a little bit about this very specific startup and financing parts. And but Elena, yeah, you said that maybe incredibly, but people are working on their businesses, trying to focus on that as much as possible. So it was quite amazing to hear from me, and so I'm very glad to talk about that, and I'll share my screen in a second, and we'll go through a couple of slides on this topic, and then very happy to take questions or have a discussion later on as well. Cool.
Thank you.
Cool. So I'll share my screen. Can you see it, Lena?
Yes.
Perfect.
Sure.
All right, good. Great. So in case you haven't heard about Point9 yet, just a really short introduction. We're an early stage venture capital firm. We're sort of based in Berlin, but we're actually quite remote and distributed, and we have invested in early stage companies from many European countries, also outside of Europe for about 10 years now, mostly in B2B SaaS and B2B marketplaces. And I'm pretty sure you know at least one company from our portfolio, which is Preply, headquartered and started in Kiev. So the topic that I want to talk about today, or at least start this discussion with, is balancing growth and efficiency in tough times. And again, the caveat is that I can only imagine, or I cannot even imagine how tough times are for people in Ukraine and founders in Ukraine at the moment and since the start of this horrible war. So I'm really not able to tell anybody how to manage a startup during war times. So I'll just talk a bit about maybe some of the general difficulties that startups see in this recession and difficult fundraising environment. And then I'm super happy to maybe learn a bit from some of you what it actually means to run a startup in Ukraine right now. So let's maybe take a look at what has changed, and I'll just very quickly go through a few charts and headlines. I'm sure you've all seen some of these headlines or other data points. So the difference between the market in 2021 and 2022 is really quite dramatic. And just as an illustrative example of this, as I'm sure many of you know, like Tiger Global, which is a very aggressive later stage or growth investor who made dozens of investments last year and invested like billions and billions of dollars, and has pretty much pulled back from the market right now. And that is just one example. And you may have read the news about Klarna, which was one of the most valuable private companies out of Europe, where there has been a huge valuation drop. And really the entire market, if you look at the public cloud stocks here, has really come down 60% or so. And usually that's a leading indicator for what happens in private markets with like some lag time. So the change has been quite dramatic. And last year, at the peak of the market, we had like zero interest rates, and many tech companies were still benefiting from COVID because they provided tools for online collaboration, online learning, digital health, and so on. And investors in this environment were happy to fund hypergrowth, maybe not at all cost, but sometimes you could think so, or it really at very, very high cost. And this has changed quite radically now within a matter of about 6 months. Now, obviously, the big and tragic event is the war in Ukraine. And in addition to that, and to some extent related to that, there is a disruption in supply chains and inflation going up, interest rates going up, and investors pay much more attention to efficiency now as opposed to just a growth. And that's why I think for any company, and it's worth to kind of reconsider, take a look at your financial plan and see if it still makes sense like this, or if you consider making any adjustments. And Elena, maybe you can give me, you or somebody else from the team, just a quick signal to make sure that the connection still holds, just in case.
Yes, sure. Awesome. Everything is working.
Perfect.
Everything is great.
Thank you. Awesome. So on the slide that you can see on your screen, I mentioned like two options that I think startup founders should consider or look at during these times. One is to become what is generally called default alive, which means that you have enough runway to take the company to profitability, so you're not dependent on the financial markets. And the other one I talk about in a second. I think there is a lot of advice there, maybe from investors or other people on Twitter and in the media, with things like, you have to become default alive, or you absolutely need, every startup needs 3 years of runway. I think this is sometimes good advice, but sometimes not. It's desirable for every company to be default alive and to have 3 or more years of runway, but it's just not always realistic. And in some cases, trying to get to that situation might also lead to wrong decisions, as we will see a bit later in this presentation. So it always depends on the specific situation. And if you cannot or don't want to make drastic cost cuttings to get to this default alive status, then a very good alternative is to become default investable. And what I mean by default investable, and then I think I've heard this term for the first time a couple of weeks ago by David Sachs, a very experienced SaaS investor. What is meant by this is that if you think about the runway that you have, and let's say that's 12 months or 15 months or 18 months, and you think about where the company will be in those 12 to 18 months with a reasonable or pretty high degree of confidence, will the company then be investable? Meaning, will you have a relatively easy time raising from the capital markets based on your progress and milestones and metrics? And if you can build a case for that, that's a very good alternative to even deeper cost cuttings to get to break even right away. Now, it does mean that you have to think about what is investable. So what will investors want, and not now, but in maybe 12 to 18 months. And that's a question that we've been looking at for a number of years. And we've been doing some surveys, and we try to put the answers on a simple napkin, which maybe you've come across already, and we're about to publish the next version of that napkin soon. Investors always look at many different things. There is a lot of metrics, especially for slightly later stage companies, but there are also many qualitative things like the team and the product and the market and competition. There is never a simple formula, but nevertheless, there are a few things and benchmarks that you can keep in mind. And on the next few slides, I'll show some of these. So growth continues to be super important, despite the fact, or in spite of what I said previously, that investors have developed a stronger preference for efficiency or efficient growth. Growth is still the #1 thing that drives investor interest. And if you look at the benchmarks from Bessemer's cloud portfolio, which is a pretty large sample size of probably hundreds of companies collected over probably 15 to 20 years, then, and you see the averages here, where companies in the 1 to 10 million ARR bucket grow at an average of 200%. And then in this 10 to 25 million ARR bucket, the average is still significantly more than 100%, like around 115%. Then you can see that the bar is pretty high still. And maybe it will go down a bit because of this appreciation of efficiency, but nevertheless, it's still difficult to get VC interest if you're not growing pretty fast, just because VCs and to a certain extent investors in general are just so focused on finding companies that can keep growing for a long time, so that they ultimately become those very, very big companies that can produce needle-moving returns for a VC portfolio. If we now look at the efficiency, since as I've mentioned, this is something that investors pay more attention to nowadays. There are various ways to look at this and track your efficiency and benchmark it. And I will focus on two of my favorite ways to look at the efficiency of a startup. One is the burn multiple, and the simple formula is that you divide the net burn by the net new ARR added. And this is somewhat specific to SaaS companies. So you have to adjust that a bit if you are not in a subscription business. And we can talk about that maybe later if you want. For now, I just have the SaaS version of this formula here, since I'm personally quite focused on SaaS companies. And what this formula tells you is really simple. How much capital do I burn, and therefore how much capital do I have to raise for $1 of net new ARR? And so using that, you can compare companies, you can look at different companies that are at certain levels of ARR, and you can look at how much total burn did it take them to get there, and that gives you a pretty good sense for the overall efficiency of these businesses. As a broad rule of thumb, a value for this metric of about 1 to 5 to 2 is generally considered to be good, and 1 to 1.5 or lower is great. This rule of thumb applies to SaaS companies very broadly in this 1 to 25 million ARR bucket. If you are significantly smaller than that, you will most likely have a higher burn multiple, because in the beginning you just have upfront costs in G&A and R&D, which don't translate into revenue so quickly. So expect this value or this metric to go down, meaning to get better and better over time. Another efficiency metrics to look at is sales efficiency. And the formula for this is what you can see here. It's the net new ARR divided by sales and marketing spend. And this formula tells you how much net new ARR do I add for $1 spent on sales and marketing. And depending on the type of your business, you can choose different periods of time. Like this could be like for a certain quarter, or it could be for a certain month, or it could be, if you have a longer sales cycle, you could look at the net new ARR in the current period and the sales spend in the previous period to account for the sales cycle. So there are various variations of this formula. It's very similar to the magic number that you may have heard about, and it's conceptually also very similar to the CAC payback period. Ultimately, it's always about trying to measure if your sales and marketing efficiency are profitable, and if you should therefore do more of them, or if you should rather pull back and try to get them to a higher level of efficiency before spending more on it. In contrast to the burn multiple on the previous slide, the net new ARR is in the numerator here. So for this formula, you want the metric to be as high as possible, and 0.75 to 1 is generally considered good. 1 to 1.5 is great, but it always depends on several factors, because not every dollar of ARR is created equal. Like depending on your churn, you might be willing to spend more on acquiring a dollar of net new ARR in comparison to a startup that has a much higher churn rate. Now, if we look at these metrics together and put them on a 2x2 chart, I think we can draw some interesting conclusions. First, if you're in this top right corner here, then congrats, then you are your overall burn multiple is quite low, and you have a very high sales efficiency, so you are in a great spot. If you're in this quadrant in the bottom right, then it means that your sales efficiency is good, but your overall burn multiple is not great. So that probably means that if you want to cut costs, you should not cut them on the S&M, on the sales and marketing side. And in fact, maybe you should not cut your sales and marketing spend at all, because that sales and marketing spend is efficient, meaning it leads to new revenue pretty quickly and at a pretty efficient rate. So if you are in this situation, you should consider shifting more budget to sales and marketing while trying to reduce some of the other costs, whether that's in product, tech, G&A or other areas. On the other hand, if you're in this quadrant on the top left, then your overall burn multiple is okay, while your sales and marketing spend, and I just see that there is a typo here, it says send, it should be spend, sorry about that, while your sales efficiency is not good. So this could be a company where growth is driven mainly organically, and then on top of that you do some sales and marketing that, however, doesn't contribute so much to the growth. So in this case, my general recommendation, and obviously it always is quite situational, but my general recommendation here would be to lower your sales and marketing spend. Try to find more efficient ways to acquire customers, and only once you've achieved that, slowly but surely increase your sales and marketing spending again, and see if you can do it while keeping that efficiency. So as you can see here, it's complicated, the details matter. I generally think you can't say every company needs to reduce costs in order to have X months of runway. It really depends how you're spending your money, how you're producing burn, and how efficiently or not efficiently you're doing that. And just to conclude here, if you are in that portion of the chart in the bottom left, that's a tricky spot. You have a high burn rate, you're spending sales and marketing in an inefficient way. It probably means you need to reduce your costs across the board, and then really think about whether you can become default alive, as I've mentioned in the beginning, or if you see a path to a company that can raise more money by the time it needs to. The last thing I have here before we maybe then move to the discussion is just a couple of tips, or let's say 9 of my favorite tips for increasing your runway. I think a lot of companies these days try to increase runway because money has become more expensive and there is a lot of uncertainty. I'm sure there are a number of additional ways to reduce costs and increase runway. So this is by no means a comprehensive list, and I'm curious to hear where maybe some people in the audience had success in terms of increasing runway. But some of my favorite ways or things that I would at least consider are listed here. And I'll just go through them really quickly. So number 1, if you can switch more customers to upfront payments, that can have a very positive impact on your cash flow. You probably have to provide some incentives for your customers, like a higher discount rate or some additional goodie. And you have to tell your sales team about it and probably create an incentive for them to sell more upfront deals. I think you need to be careful that you create the right boundaries here, because you're obviously sacrificing revenue or MRR or ARR in exchange for the upfront cash by doing these discounts. So don't do too much of it. Then if you are a SaaS business and you have some customers on older, lower, like less expensive pricing plans, then now would be a good time to de-grandfather them. You need to do it carefully, of course, to avoid that that there is a like a big revolt maybe from some of these older customers, but I think it's generally manageable, and it might be a good opportunity to create some additional revenue and cash. More generally, pricing is such a high leverage thing you can do to improve your business in general. I think it's always good to experiment with pricing, and in particular try to increase pricing, because in so many cases startups don't charge enough and they only find out when they try to increase. So trying to increase your pricing is generally a good idea, but in a situation like this it might be a particularly good one. The next bullet point here sounds quite harsh, but every company has a certain percentage of people that are just not working out that well. Nobody has only perfect hires, like everybody makes hiring mistakes. So this might be a relatively good opportunity to let go of those 5 to 10% people that you consider like your lower performers. The next point, move on from any VP that isn't amazing is also something that I think is true generally. Like even if you have enough runway, if you've hired an expensive VP, but he or she doesn't work out, and after 1 or even 2 quarters, you're not seeing really the difference, then it's almost always time to let that person go, because you didn't hire a VP to find out why they are not working out and analyze the problems and try to come up with a solution. You really hire these expensive people to solve big problems for you, whether that's in sales, marketing, product, engineering, customer success, finance, people, or really any department. The next one, number 6, is a sometimes quite low-hanging fruit. Get better at collections. Like if you have some issues with your accounts receivables, and many companies do, just hiring somebody part-time, chase those open invoices and try to bring in some cash sooner might pay for themselves. So that's something to consider. The next one is kind of bad if you are on the receiving end of this as a SaaS company during times of like these, during a recession. A lot of companies will renegotiate all kinds of contracts, whether that's with their landlords or with their SaaS providers. So that's a challenge for SaaS companies during these times. But when it comes to your own bills, it's an opportunity for you to decrease costs. So if you try to renegotiate deals with any kind of vendor, they won't be shocked that you're trying to do that, because other people probably gave them these calls already as well. The next point here is consider reducing your paid marketing spend. Even if your paid marketing is quite efficient, and if it's not efficient, you shouldn't be doing it anyway. You can consider just reducing it by eliminating like the top 10 or top 20% marginal spend where you have the highest CACs, because it's quite often the case that as you increased your budget, your CACs went up because the lowest hanging fruits have already been gone, and then you're getting to higher and higher, more and more expensive keywords, for example. So if the payback period on your last 20% of spend is quite high, I would consider decreasing that spend during times like this. And really then the very last point that I mentioned here is that you can consider venture debt or revenue-based financing if you need to bridge your time, buy yourself some additional months to get to break even or get to the point where you can raise an equity round. You just have to keep in mind that it comes with a cost and it also comes with a risk. So if you take on a debt and then 6 to 12 months later you haven't achieved what you were hoping to achieve, then you are in even bigger trouble than you were by the time when you decided to raise that debt. Thank you very much for listening, everybody. I'm very happy to have a chat with you now, and I've also put my email address and Twitter handle here on the screen if you want to reach out later.
Thank you so much for the presentation. It was super insightful, I think. So now we will switch to the Q&A session. We have a lot of questions. I needed to, to amend them during the lecture because you answered some of them. So I needed to think of something more or dive deeper on a couple of questions. And we have plenty of questions, not only regarding the balancing of growth and efficiency, but also about point-time capital, about the current market situation, about the investments, about hiring a sales team, about metrics. So I suggest that we start with the current topic of our presentation, and then if we have some time and if we have some really interesting questions regarding the other topics, we will also touch them.
Sounds great.
Okay, so the first question will be, you mentioned a couple of metrics, and the metrics for the just to understand if the company is efficient enough and if there is a balance between the growth and efficiency right now. Can this metric and the metrics that you shared used for startups that act with other business models other than B2B SaaS? Can, for example, a subscription-based startup or a marketplace startup, or let's say a mobile app startup, use the same metric to identify if they're efficient enough?
Yeah, it's a good question. I think some of the general principles are similar, right? For every company, or at least every company that has the concept of acquiring customers and monetizing them over a longer period of time, as opposed to being a really highly transactional business, needs to think about what does it cost to acquire a customer, and then what's the, how often will that customer keep coming back? So what's maybe the order value and the frequency in case of a marketplace business. And so you'll have to think about CAC efficiency, CAC payback times, and these things. But there are also pretty significant differences. So if it's a consumer subscription company, for example, it's very normal that you have a higher churn rate, right? Consumers just churn at a much higher rate in comparison to businesses, and so you can't compare a consumer subscription company with a B2B company, because that wouldn't be apples to apples. It would really be apples to oranges. So if you want to compare yourself to other companies, then you'll have to pick similar ones. So the consumer subscription version of this napkin, for example, would look quite different. And then when you look at a marketplace, for example, maybe you want to focus on different metrics early on, right? Because liquidity is so important that as a marketplace founder, you might intentionally like not charge significantly for maybe several years. So yeah, I think there are definitely important differences between the business models.
Thank you. I see. And in which cases capital efficiency matters more than growth? So, for example, right now, as I understand, the fundraising processes are poorer. They look poorer than in 2021, and the industry is a little bit cold and not that hot as it was in the 2021. But maybe there are some other different situations in which capital efficiency is and efficiency in overall in the business matters more than the growth.
Yeah, I'm not quite sure if I got it right, just to make sure. Is the question like, or maybe you just elaborate a bit to make sure that I got it right.
Yeah. So should the startup be capital efficiently all the time, or there are periods of time in which it can, sacrifice some efficiency and burn maybe more money, just to grow faster?
Okay, thank you. Thanks for clarifying. I got it now. So maybe the question is a bit like, should a company have been more capital efficient already last year, maybe despite the fact that they maybe had the opportunity to raise a lot of money? So I think to a certain extent, it does make sense to keep like the cost of capital in mind, right? Like if capital is very cheap, you may want to take advantage of that and raise a lot of money and spend it. Obviously not in a crazy way, right? Because if like you acquire customers at insane costs, then you just don't get the benefit of that. But to a certain extent, if capital is cheap, it makes sense to accept a somewhat lower level of efficiency in order to gain market share and maybe in order to really lead the way and ahead of the competition. So to some extent, yes, listen to like what maybe investors say and adjust to that. But at the same time, I think companies now also do a lot of things that they probably should have done last year already, and now was kind of like a wake-up call, right? Like when money is quite cheap, companies like tend to overspend and overhire, and then occasionally it's almost like you need this wake-up call to become more efficient again, and maybe then you'll think, well, actually this didn't even make sense in 2021 in some cases.
I can see. I see. So there are a lot of conversations about the profitability of startup. And for example, when we were talking about fundraising in 2021, a lot of VC funds mentioned that profitability of a startup, or if they're close to profitability, is a red flag or an orange flag or a yellow flag. There are some concerns about the profitability. But currently, the narrative is changing sometimes. So what do you think about that? So is the profitability of a startup a red flag, or it's not right now? And maybe overall,
Yeah. I don't know. I think maybe investors tend to overdo and overreact, right? And maybe when the markets go up, they might give this kind of advice, which I don't agree with, like profitability being a red flag. And then when things go down, the same people might tell everybody they need to get to break even immediately. So I think the truth is more nuanced and somewhere in the middle. I think maybe the thinking behind this statement of considering profitability a red flag is maybe it means like you're not aggressive enough, you could spend more to grow faster, get more market share. But I would definitely not say this without having looked much deeper and without actually being able to point out specific areas of underinvestment, because there are also companies that grow fast and they are close to profitability. And especially in SaaS, which is such a great business model, companies can grow fairly efficiently and quite profitably, or at least close to profitability.
I see. I see. Thank you. Thank you. Because I thought that we need a definite answer to that question, because a lot of people raise it right now, and a lot of funds kept saying that profitability is a red flag. So everybody was really confused, and they're really confused when the tough times came and they see that crisis is approaching, and a lot of investors try to curb their investments into startups. And right now they need to kind of be profitable and grow fast somehow at the same time. So yeah, thank you.
Sure.
Thank you. So let's talk a little bit more about the markets. So what are the most common mistakes and the worst mistakes that a startup can make during their expansion to the new markets? Maybe something based on your experience that you saw in your portfolio companies or other startups that you know.
Yeah, so I think a classic mistake is when we talk about expansion in terms of geographic expansion, is that you're a European startup and you have some success here with European customers and you want to expand to the US, and then you think you can do it just by hiring somebody there who maybe has a great resume, but is maybe even somebody from a bigger corporation, but not really a startup person. So I think it's maybe founders take certain skills for granted because they have them, which most people in the world do not have. Like most employees, and especially people from bigger companies, they are not so creative, right? Like they usually come in and then they apply their playbook from the last company, or they keep scaling what already works at a smaller level. But when it comes to new products or new markets, or building a team from scratch, this is pretty much a founder job. And so I think all of the companies from our portfolio that have succeeded in expanding to the US did it by having one of the founders move there and then hire great people there, but not hiring them remotely and assuming they would do the job. Then when it comes to like our other types of expansions, like let's say going from an SMB focused business up market to a more enterprise focused companies, I think it's easy to underestimate just how difficult this is, right? Because it's not only the product that changes. If you change to a different customer segment, it really affects everybody in the organization, how you market, how you sell, how you do customer support. So I think maybe like trying to do this too fast or not putting enough resources on these types of expansions is maybe another mistake. Yeah, I'm sure there are lots of others.
I see. So if I heard you correctly, so you suggest that it's better to relocate one of the founders to the respective market to which the company wants to enter, wants to expand, and to hire the local team. Does this strategy work for all the startups, or there are cases in which startup cannot do that and still succeed? Even if they are, for example, in Europe and they need to expand to the US, or they want to?
I think it depends on the type of people that you want to hire in these markets, which probably depends on the type of company that you want to build and maybe the product that you're selling. Of course, there are very successful remote first or remote only companies. So maybe to a certain extent, they prove that this is possible. I think for an open source company where you don't really need commercially experienced people until somewhat later in the journey, because the first years are all about getting open source adoption. I think this is maybe an example where you can do pretty remotely. Or if it's like an SMB focused company where everything is happening over the phone, because you don't have like field salespeople or anything like that. to a certain extent, this can be done like in a kind of geo-agnostic way, but where you typically need experienced people, and they just happen to be mostly based in the US, because that's where most of the SaaS companies and large tech companies have been built, is on the one hand, when it comes to like enterprise sales or enterprise marketing and some other areas of skills where I think Europe is lagging behind compared to the US. And then the other area is, on the other hand, like when you reach a certain scale, right? Like when, I don't know, maybe you want to grow from 10 million to hundreds of millions in ARR, then you probably want to try to hire people who've already done this, or at least parts of it, and then attracting these people is just so hard that I think you increase your chances by physically spending time with candidates as opposed to trying to do it all remotely.
I see. And in your experience, for example, if a startup coming from Europe, Eastern Europe, Baltic countries, wants to start selling on the US market, do they need to have a local sales team or a sales representative, or they can still build a sales team based in Europe somewhere and still sell successfully to the US? Because there is, for example, an example of Lendlease, I think. They have, at least a year ago, they had a European team and Eastern European sales team. And they mentioned a lot of times that they still succeeded on the US market. Judging by their metrics, it's maybe true. Yeah. But what's your opinion here?
Yeah, so I would say this works with a pretty light sales model. Like if it's product-led growth, or like product-led and sales assisted, so that the sales process is relatively easy, like maybe a couple of calls or product demos. I think then it can work. But if it's a company that tries to sell like 6 or even 7-figure deals, then it just gets harder, right? Then you might have to visit people like physically. I mean, obviously during Corona, everything has been completely remote, but this is coming back now. And if you have a competitor that like is locally present, you probably have a disadvantage if you can't meet your potential customers as well. So I would say the more enterprisey it is, the more of an advantage it is to have people on the ground in that market. I would say another slight disadvantage that you have if you have nobody in the US, but you're selling in the US, is I don't know, time zones and native speakers and people like really understanding American businesses. I mean, to a certain extent, you can find these people in Europe and hire them here. But there are probably some limitations to that as well.
Okay, I see. So we touched a little bit the topic of the distributed or remote teams. There is a huge narrative right now about returning to office or not returning to office, in European countries, in the US. So you've probably seen this email from Tesla that all people need to come back to the offices. And what's your opinion on remote and distributed work for startups at all stages, beginning with the pre-seed stage and up to the Series C, Series B pre-IPO stage?
Yeah, so this is actually a topic that we've been discussing for a much longer time than just like the Corona triggered like work from home trend, because we as a team have always been distributed. So I'm in the south of Germany. One of my partners is in Berlin. Another one is in Paris. One is in Lisbon. Some of the other people are in London. So we are a really distributed team. It works well for us because we're a small team and we're not growing fast. If you run a startup, you have very different challenges, right? Like when you hire a lot of people and you have to onboard them and form a cohesive team. So I think the fact that it works for us doesn't mean that it'll work for your typical startup. For startups or bigger companies, I think, even though I've been thinking about this for more than 10 years, I don't have the answer. I think the answer is it depends on the type of company that the founders of the leadership team want to build, right? I think some people just have a style where they are more effective with people in the room or close by, and for them, it's hard to switch to remote, and maybe then they shouldn't, right? And then there are other people who love asynchronous work and who can therefore benefit from being able to hire people in all kinds of places. So I think there is really no right or wrong. I think it's so dependent on the culture of the company, and that is primarily driven by the founders and the early team members. So I guess if you are a Tesla employee and you don't like it, maybe you should just change to a company that is more in line with your style.
Okay, thank you. Thank you. Maybe they should change their job to, Twitter, because
yes, exactly. Yeah. You probably can't change Elon, so you have to maybe change your job.
Yes, much harder. Okay, so given that we already touched the topic of Point9 Capital, what do you do to make your remote work more efficient inside the Point9 Capital team? Maybe there are any tips,
Sure, yeah. So we started this quite organically when Pavel and I started Point9 about 10 years ago. It's been a tiny team, but we already were using like various online tools like Basecamp back in the days that we're still using to like basically log all kinds of information, and we use Zendesk for our deal tracking. So we keep discussing companies asynchronously over Zendesk with our somewhat bigger team now. So there is more asynchronous communication in comparison to a company that is in one office, which then allows team members to get up to speed by reading and contributing, even though they haven't been in that same location. But I think all of this is, probably nothing that I could say is really new or innovative, right? I think in the last 2 years, so many companies have learned how to become efficient as remote companies with tools like Loom, replacing many meetings and having a certain cadence for like the equivalent of a Monday stand-up and things like that. And maybe the only thing I would add is that you should still try to meet in person, right? And we do this at Point9 several times a year as well, and it's always very inspiring and gives energy. It's just very different from spending a couple of days together in person. And I think that's also what I hear from pretty much all founders, that as a remote company, you have to invest some of the budget that you spend on office into traveling to make sure that people really spend time with each other in person.
Thank you. I think that a lot of startups here wonder what's the decision-making process at Point9 Capital. Can you please share a little bit of information about that? Because a lot of people think of Point9 Capital as one of the top B2B SaaS funds in Europe. So I think that they will, for sure, will be interested in talking to you in the future.
Well, thank you. So we try to make pretty fast decisions, and last year things were usually so fast that we often really had only a week and sometimes less than a week to make a decision. But if we can, we prefer to have, let's say, 2 or 3 weeks for that process. And it's mainly because the commitment when we invest in a company is so big, not mainly in terms of the capital, but just because we commit to spending so much time with a company over many, many years, and we can only invest in about 10 to 15 companies. That's basically constrained by the bandwidth that we have in terms of companies that we can add to the portfolio. So because of that, the bar is quite high, and we do this very, very seriously, but we try to compress all our work and due diligence into a relatively short amount of time. So ideally, after the first call or maybe a second call, it's clear for us that this is a high priority or not. And if it's not, then we try to pass quite quickly. And then when it's a high priority, we try to really go in deeply over the next days or maybe few weeks, and then come to a decision quite quickly. And you asked, I think, specifically about decision making. So we decide as a team, but it doesn't mean that it's a democratic decision, or that we vote and then it's done when it's a majority is in favor, or that it's that it requires consensus. So in the end, it's not everybody in the team needs to be as convinced as like the person leading it. And it's sometimes also not possible to bring everybody at exactly the same amount of information in fast processes. And technically, there is probably something in our contracts, which I haven't looked at for 10 years, which says how we need to resolve a situation where one of us really wants to invest and the others don't. But we never looked at whatever is written there in these agreements. So far we always managed to either convince each other to do it or to convince each other to not do it. And then we have a lot of trust for each other. And so if let's say two of my partners really want to invest in a company and I'm maybe less clear about it, then I will challenge the decision, but ultimately I trust them to make great decisions, even if I don't agree with all of them.
I see. Thank you. Thank you. About that, like smart money on your, or like value add that you usually give to the startups. So can you mention a couple of things with which you usually help your portfolio companies after you invest in them?
Sure. Yeah. I mean, there's a lot of different things, and maybe what a company needs the most is also like not the same for each company. It depends on the strengths and the weaknesses of the founding team, in which area they need more help. I think we're maybe to start with where we are not great at. I think we can't do much on like product tech or getting to product market fit, or maybe product market fit a little when it comes to like some strategic discussions and decisions in terms of the customer segments to pick or to optimize for. But we would never invest in a company where we don't think that the founders know more or less what to build and they can build it from a technical perspective. We are more complementary or additive when it comes to like the sales strategy, the marketing plan, like hiring people, thinking about like how to build the organization, like thinking about like who to hire and in which sequence, and then how to hire them. So it's these topics where we are working very closely with the founders of our portfolio, and then fundraising, of course. Like we at any given time we have one or two or several companies going out for a Series A or a Series B. So that's something that we have a lot of experience with in terms of getting the company ready for the next stage and making sure that they pitch the company in the right way and talk to the right investors, and that these investors also pay attention to it. Yeah, so I think it's both what we do as board members or close advisors in all of these situations. And then founders also get a lot of value by being connected to other founders from the portfolio or this bigger Point9 family, where we have events online and now post-COVID, fortunately also offline events in addition to meeting and connecting people on Slack. So there is a lot of learning and information, knowledge sharing between the founders across the Point9 family and also people below the founder level in various functions.
I see. Thank you. I think we will have the last question that will be very interesting to a lot of startups here today. So you have one portfolio company with the Ukrainian team and Ukrainian founders. I think one. I haven't checked, so I know properly that is your portfolio company. Will you consider a Ukrainian startup or a startup founded by Ukrainian founders or having Ukrainian team right now as a potential investment? I understand that there are a lot of factors involved in decision-making process, but still, is it a risk for you that some of the people from the team will be in a country that is in war?
Yeah, I mean, we're very, very happy to be shareholders and investors in Preply. Obviously, the company has gone through very difficult times and might still go through difficult times because of this. But we would be totally open to investing in more companies from Ukraine. Obviously, there are things that need to be discussed then, but I think we would be mostly in listening mode there, because people from Ukraine have already thought so much more about like how to deal with these challenges and maybe what it means for hiring people, if it means, I don't know, relocating people or hiring people from outside of Ukraine maybe earlier than planned. As horrible as the war is, and as much as I hope that it'll end soon, it doesn't make us less interested in investing in Ukrainian founders at all.
Thank you. So I think we don't have any more questions. And if you do have any questions, it's a shout out to our audience. Here, just follow Christoph on Twitter or reach out to the email that he shared with you, because I think that he will be pretty open to answering them if they're really burning and interesting to you. And Christoph, thank you for joining us today. It was very insightful and a very great conversation and a lecture. And I hope everybody liked it here. So if someone wants to reach out to Christoph, please do.
Thank you. Well, thanks again for inviting me, Elena. Thanks everybody for joining, and please feel free to reach out. I think, Elena, you can connect us in case somebody didn't write down the email address. You'll probably also find me on Twitter, LinkedIn, and so on.
Sure. Thank you for joining us, and have a nice evening.
All the best. Stay safe.
Bye-bye.
Take care. Thank you.